Welcome back to the Investing Iguana Daily SGX Market Digest, where we cut through the noise and deliver actionable insights for Singapore retail investors. Iggy here, your guide to navigating the Singapore exchange with a global macro lens. Today's market served up a mix of steady gains, executive shuffles, and earnings surprises that reveal the real story behind the ticker movements. The STI closed at 4,168.42 points on October 15th, ticking up a modest 0.32% from the previous session. Trading volumes remain solid as retail participation holds near four-year highs and institutional money continues flowing into Singapore equities. The broader sentiment remains cautiously optimistic as investors digest corporate updates and position for the final quarter push. Singapore Airlines and Scoot delivered solid passenger traffic growth in September, with combined traffic rising 3.7% year-on-year. The increase outpaced the 2.5% expansion in capacity, pushing the passenger load factor up 1 percentage point to 87.1%. SIA carried 2.2 million passengers, while Scoot transported 1.2 million, reflecting an 8% combined increase. The cargo side faced headwinds from Typhoon Ragasa, which disrupted East Asian routes and pulled the cargo load factor down 1.8 percentage points to 56.2%. Shares closed at 653 Singapore dollars, up 0.2% before the announcement. Iggy's take: SIA's passenger performance shows the airline is executing well in a competitive environment. The load factor improvement tells us demand is outstripping supply, which is exactly what you want to see for pricing power and yield management. The cargo weakness is weather-driven and temporary, not structural. With the group operating 129 destinations across 37 countries and retail participation surging across SGX, this operational momentum should translate into earnings strength when results drop. For income investors, SIA remains a core aviation play with dividend potential tied to these improving operational metrics. Jardine Cycle & Carriage appointed Samuel Tien as its new independent chairman, effective November 11th. Marking the first time the company will have an independent chairman. The 71-year-old former OCBC Group CEO will succeed John Witt and brings decades of banking and capital markets expertise. Tien currently serves as a director at Singapore Exchange and Mapletree Investments, adding strategic depth to Jardine C&C's board. The stock closed 0.8% higher at 28.74 Singapore dollars before the news. Iggy's take: this appointment is a big deal from a governance perspective. Having an independent chairman with Tien's banking and institutional background signals that Jardine C&C is serious about enhancing shareholder value and board oversight. For a conglomerate with operations spanning Indonesia and Vietnam, strong independent governance matters when navigating complex emerging markets. The market's positive reaction reflects confidence in this leadership upgrade. Long-term investors should view this as a structural positive that could unlock better capital allocation and strategic focus going forward. Aztech Global posted a 21.2% drop in net profit to 10.8 million Singapore dollars for the third quarter ended September 30th, down from 13.7 million in the prior year period. Revenue fell 19.9% to 133.5 million Singapore dollars as subdued customer demand weighed on results. Earnings per share came in at 0.0141 Singapore dollars versus 0.0178 previously. The stock closed 0.7% lower at 0.675 Singapore dollars before the results. Iggy's take: Aztech's results highlight the challenge facing electronics manufacturers as global demand remains choppy. A 20% revenue decline paired with margin compression is tough, and the earnings per share drop confirms the pressure on profitability. The key question now is whether this is cyclical weakness that reverses with a demand recovery or something more structural. Investors need to watch the next quarter closely for any signs of order book stabilization. Until we see revenue growth return, This remains a show-me story rather than a buy-the-dip opportunity. Q&M Dental announced plans to acquire an equity interest in a Thai dental group, targeting a network focused on accessible, standardized patient care in high-traffic urban and suburban locations. The purchase consideration will be satisfied through a mix of cash and new Q&M shares, based on an enterprise value of approximately 1.95 billion baht, or 77.7 million Singapore dollars on a cash-free, debt-free basis. Shares jumped 3.4% to 0.455 Singapore dollars before the announcement. Iggy's take: this Thailand move makes strategic sense for Q&M as it diversifies beyond Singapore's saturated dental market. The target's focus on high-traffic locations aligns with Q&M's playbook of volume-driven, accessible care. The 77.7 million Singapore dollar price tag is material but not excessive if the network delivers consistent cash flow and growth optionality. The share price pop shows investors are hungry for growth catalysts. Watch how management finances this deal and whether they can replicate their Singapore operational playbook in Thailand's different regulatory and competitive landscape. Food Innovators swung to profitability with earnings of 206,000 Singapore dollars for the first half of fiscal 2026, compared to a loss of 1 million Singapore dollars in the prior year period. The company, which listed on the Catalyst board in October 2024, attributed the improvement to growth in its core business. Shares fell 4.5% to 0.191 Singapore dollars before the news. Iggy's take: a return to profitability is always encouraging for a recently listed small cap, especially when it's tied to core business growth rather than one-off gains. The 206,000 Singapore dollar profit is modest, but it's a start, and the trend matters more than the absolute number at this stage. The share price weakness before the announcement suggests the market may have been pricing in worse news or simply reflects typical small-cap volatility. For investors with appetite for microcap growth stories, this turnaround narrative deserves monitoring, but position sizing should reflect the liquidity and volatility risks inherent in catalyst stocks. Today's market action reinforced several key themes. First, operational excellence matters. SIA's traffic numbers show that companies executing on capacity management and service quality are winning market share. Second, governance upgrades like Jardine C&C's independent chairman appointment create long-term value, even if they don't immediately move earnings. Third, earnings quality matters more than ever. Aztech's results remind us that revenue growth and margin protection separate winners from strugglers in this environment. The bigger picture remains constructive for Singapore equities. The STI's 21.66% year-on-year gain reflects improving sentiment, rising retail participation, and institutional inflows that topped 511 million Singapore dollars since February. With IPO activity strengthening and trading volumes hitting four-year highs, the market structure is healthy. For retail investors, the strategy remains focused on quality companies with operational momentum, sound governance, and exposure to structural growth themes. SIA's passenger strength, Q&M's regional expansion, and Food Innovators' turnaround all represent different risk-reward profiles worth evaluating against your own portfolio objectives and time horizon. A consortium including Singapore's Temasek, BlackRock, Microsoft, and NVIDIA announced the acquisition of Align data centers for $40 billion, marking the largest data center transaction ever. The deal secures critical AI computing capacity for the AI Infrastructure Partnership members, which also includes Abu Dhabi's SGX, Kuwait Investment Authority, and Elon Musk's XAI. Aligned operates 50 campuses across the United States and South America, with 78 data centers under management or in development. Iggy's take: this mega deal underscores the infrastructure arms race powering the AI revolution. Temasek's involvement signals Singapore's strategic bet on AI infrastructure as a long-term growth driver. For local investors, this validates the importance of exposure to AI-enabling sectors, whether through REITs with data center assets, tech infrastructure plays, or companies supplying the data center ecosystem. The $40 billion price tag reflects how critical computing capacity has become. This trend will create winners across the value chain, from power utilities to cooling systems to specialized construction firms. Thanks for reading today's Investing Iguana Daily SGX Market Digest. Drop your thoughts in the comments and let me know which stocks you're watching. If you want deeper dives, exclusive research, and premium content, consider upgrading to our paid newsletter. Keep investing smart, Singapore.